Wall Street just broke its all-time record. But one of the world's top analysts says this is the final rally before a brutal collapse. Beneath the surface, something doesn't add up. On the same day that the S&P 500 and Nasdaq soared to record levels, one of America's top market analysts issued a stark warning. A recession is still coming. Not just a slowdown, not just a technical dip, a real contraction. And according to him, it may arrive when no one expects it. This warning didn't come from a fringe economist or a social media doomsayer. It came from a name the markets respect, David Rosenberg. The same Rosenberg who accurately predicted the 2008 crash and warned about the COVID recession months before it hit. And now, while the headlines celebrate new highs, Rosenberg is calling this a bear market rally dressed in bull's clothing. So why is he seeing danger when the rest of Wall Street is partying? To answer that, we have to look past the index numbers and into the economic data that no one's talking about. First, real disposable income is falling. Despite strong job reports and a resilient consumer narrative, the average American's take-home pay adjusted for inflation is declining. People are spending more, but saving less. Credit card debt is at an all-time high, topping $1.3 trillion, and delinquency rates are quietly rising across all age groups. Second, corporate profits aren't matching the market euphoria. Earnings growth has stalled for many sectors, especially outside of tech. In fact, if you strip out the top 7 AI stocks, the broader S&P has barely moved this year. Rosenberg says this is classic late-cycle behavior. Markets boom in the final innings of an expansion right before the rug gets pulled. Remember the dot-com bubble? The Nasdaq hit new highs in early 2000 right before the crash wiped out trillions. But 2007, when home builder stocks peaked months before the housing market collapsed. There's a rhythm to this pattern. Rosenberg believes we're hearing the same drumbeat again. Now here's where it gets more serious. The yield curve, one of the most reliable recession indicators in history, has been inverted for over a year. That means short-term interest rates are higher than long-term ones, which only happens when markets expect trouble ahead. Historically, this inversion precedes a recession by 12 to 18 months. We're now 14 months in, and yet the market keeps climbing. This is what economists call a lag effect. When the Fed hikes rates, the damage doesn't show up right away. It takes time for higher borrowing costs to hit corporate budgets, time for consumers to cut spending, time for layoffs to show up in job data, and time, Rosenberg says, is just about up. Now here's where the psychology kicks in. Bull markets create belief systems. Once investors see a few rallies, they start to trust the trend. They ignore bad news, they dismiss warnings, they tell themselves, this time is different. But that's when risk is at its highest. Rosenberg calls it the complacency trap. Right now, investor sentiment is near euphoric. The AAII bull-bear ratio is at one of its highest levels in 5 years. Retail inflows into equity ETFs are surging. Margin debt is climbing again. And volatility? Crushed. The VIX is trading near multi-year lows. That's not how bottoms are formed. That's how tops are built. Meanwhile, the Fed isn't helping. After holding rates steady this month, Powell gave his most cautious press conference in over a year. He admitted inflation isn't cooling fast enough. And while markets are still pricing in a rate cut later this year, the Fed hasn't confirmed anything. In fact, they're walking a tightrope. Cut too soon and inflation could reignite. Wait too long and the economy could stall. It's a lose-lose scenario, and that's what makes Rosenberg's warning so potent. He's not saying the market will crash tomorrow. He's saying the foundation is weak, and when the sentiment shifts, it will happen fast. Because right now, markets are priced for perfection. No inflation shock, no earnings miss, no geopolitical risk. But perfection never lasts, and this is where the story takes a turn. If a recession does hit, even a mild one, valuations are far too high. The S&P 500 is trading at over 20 times forward earnings. Historically, during recessions, that number drops below 15. That would imply a 25% correction, even in a soft landing. In a hard landing scenario, it could be worse. And here's the part that most investors miss. Market tops are always invisible in real time. They only become obvious in hindsight. People didn't know 2000 was the peak until months later. They didn't realize 2007 was the top until the crash was already underway. It's only when the music stopped that people noticed the floor beneath them has vanished. Rosenberg is urging investors not to wait for the headlines, because by the time recession is official, it's already too late. The MBA, the group that declares U.S. recessions, usually announces it 6 to 12 months after the fact, which means the damage is already done. So what can smart investors do now? They can study the signs. They can recognize that a booming index doesn't mean a healthy economy. They can protect downside, diversify risk, and position for volatility. Because volatility is coming, whether it arrives in weeks or months, the conditions are ripe. You have inflated valuations, overstretched sentiment, delayed policy effects, and a Fed that may be out of ammo. Even a small tremor, a surprise CPI print, a geopolitical flare-up, or a credit event could trigger a chain reaction. This is why smart money is hedging, even as retail piles in. It's not about fear. It's about probability. And right now, the probability of turbulence is rising. Rosenberg might be early, but he's rarely wrong, and ignoring someone with his track record, just because the market is green, could be a costly mistake. The question isn't whether we'll see another recession. The question is whether you'll see it coming in time to prepare. Because when everyone's cheering at the top, that's usually where the story ends. But here's what that really means for the months ahead. Because once that tipping point hits, there's no slowing it down. Recession doesn't announce itself with headlines. It shows up in earnings, in defaults, in sudden waves of layoffs that start small and accelerate without warning. That's why Rosenberg's warning matters now more than ever. Not when it's obvious, but when it's ignored. History has shown this exact pattern before. The market climbs on sentiment, not substance, right before it craters. And the investors who pay attention to the signals rather than the noise are the ones who survive what comes next. This moment is not about panic, it's about preparation. Because every bubble ends the same way, first slowly, then all at once. And the window to prepare doesn't stay open forever. There's also the issue of timing. Markets don't crash when people expect them to. They crash when confidence is high, when no one is positioned for risk, and when liquidity vanishes in an instant. And right now, confidence is overflowing. Valuations are stretched, speculation is rampant, and corporate earnings are starting to miss. The longer this goes unnoticed, the harder the landing becomes. Because you can only defy gravity for so long until the fundamentals catch up. The question isn't if a correction comes, it's who's ready when it does. If you value this kind of clear, fact-based analysis, and you want to stay ahead of the next major financial shift, now's the time to subscribe. We break down complex macro events, decode market manipulation, and expose the stories no one else would tell. Stay sharp, stay informed, and we'll see you in the next one. And before we wrap this up, there's one last signal that investors can't ignore. The bond market, often the most reliable predictor of recessions, is still flashing red. The yield curve remains deeply inverted, and that inversion has preceded every major U.S. recession in the last 50 years. Smart money isn't watching the headlines. It's watching the bond market, the credit markets, and the real economy, because those are the cracks that form before the avalanche hits. So while the media celebrates record highs, those paying attention are quietly preparing. And that preparation could be the difference between surviving the next downturn or getting wiped out by it.